As of 1st April 2026, the Income Tax Act 1961 has officially retired after 65 years and the new Income Tax Act 2025 has taken over. The CBDT has just notified the Income Tax Rules 2026, and if you're a salaried individual staying in a rented house in Bengaluru, Pune, Hyderabad, or Ahmedabad, the news is even better than we anticipated. While many are being defaulted into the new tax regime, ironically not anymore new, the 2026 revisions to allowances, perks, and metro status to 4 new cities have turned the old regime into a powerful way to increase your take home pay. Today, we are going to analyze a 25 lakh CTC to show why the old regime is making a massive comeback. We are looking at a net saving of about 1 lakh compared to the default new regime. Let's break down the rules. The newly notified rules have 3 major wealth pillars for 2026. 1. Bengaluru, Pune, Hyderabad, and Ahmedabad have joined the 50% HRA metro list from 40%. So now we have 8 metro cities instead of 4. This hike effectively lowers your taxable salary if you live in these cities. How? We'll understand this shortly. 2. After remaining unchanged for decades, the children's education and hostel allowances have been hiked to Rs 3K from Rs 100 and Rs 9K from Rs 300 respectively per month per child for up to 2 children. 3. After decades, the government has tripled the tax-free perk reimbursement limits to match modern fuel and maintenance cost for your car. Here are your new monthly tax-free limits. For small ICE cars and all EVs. By small cars, I mean where the engine capacity is up to 1.6 liter. New limit is 5K per month from 1.8K. Big ICE cars having engine capacity more than 1.6 liter, 7K per month from 2.4K. And if you hire a driver, then 3K per month from Rs 900. For perquisites, the specified employee threshold is now 4 lakhs from 50K. This effectively means no tax on perks if your salary is up to 4 lakh per year. Remember, this is the annual limit, which is same as the basic exemption limit in the new tax regime. Let's understand these changes better using a simple story. Imagine you are a salaried person working in a company in Bengaluru. Your CTC is 25 lakh for tax year 2026-27. Remember, from April 2026 onwards, no more confusion of previous year and assessment year. These are now replaced by tax year. So CTC for TY 27 is 25 lakh. Basic 50% of CTC, that is 12.5 lakh. HRA 40K per month, 4.8 lakh. CTC also includes employer's PF contribution at 12% of basic, that is 1.5 lakh. Gratuity at 4.81%, that is, it is calculated at 15 days of basic salary for every year of service, assuming a 26-day work month. So for the entire year, it comes to 60,125. Fuel reimbursement, let's assume you own an EV, 5K per month, and you drive your car. Balance special allowances. Let's also assume you stay in a rented place and you pay rent 48K per month. Let's first compute gross salary. Basic salary 12.5 lakh, HRA 4.8 lakh, special allowance 4,99,875, total 22,29,875. Here you need to remember 2 things. Fuel reimbursement, this is tax free, so let's not include it in the gross salary. Then employer's PF contribution and gratuity contributions go directly to the respective funds, so these are not part of the gross salary. Let's now compute exemptions. First, HRA. HRA exemption is least of these 3. actual HRA, which is 4.8 lakh, 50% of basic because Bengaluru is now a metro city, 6.25 lakh, or rent paid, that is 48k per month minus 10% of basic. So rent paid for the year is 5.76 lakh minus 1.25 lakh. Difference is 4.51 lakh. That's your HRA exemption. Now let's digress a bit and understand the impact of adding Bengaluru as a metro city. For this, let's use the same scenario, but let's tweak the numbers a bit. Let's say HRA is 45k per month, 5.4 lakh. Before the change, Bengaluru was not a metro city, so HRA exemption was capped at 40% of basic, which is 5 lakh. Then rent paid minus 10% of basic. Let's assume rent paid is 55k per month, so 6 lakh 60,000 minus 1 lakh 25,000. The difference is 5 lakh 35,000. Least of these three, that is 5 lakh, would be HRA exemption. Now let's see what is it after the change. HRA exemption is now capped at 50% of basic, so it is 6.25 lakh, and the least of these three would now be 5.35 lakh. As you can see, your HRA exemption has gone up by 35k. Here you need to remember one thing. Because the rent is more than 50k per month, you will have to deduct TDS at 2%. And if you want to know more about this HRA exemption, TDS on rent, then PF and gratuity exemptions, I have separate videos on each of these topics. Links will be in the description. Let's now move to the children allowances. First, education allowance. Let's assume you have 2 children. So maximum exemption is 3k per month. So 3k multiplied by 12 into 2 children, so 72k. Then hostel allowance 9,000 multiplied by 12 into 2,16,000. Total is 2,88,000. Remember, you can avail the entire 2.88 lakh as exemption if your children study in hostel. Otherwise, your exemption would be limited to 72k. Let's now move to deductions. First, standard deduction. In old regime, it is limited to 50k. Then professional tax in Karnataka is 2.5k for the entire year. Then let's say your ATC deduction, that is PF contribution, is 1.5 lakh. Let's assume your health insurance premium is 25k. Let's also assume you pay interest on your EV, so you can claim deduction up to 1.5 lakh under section 80E. Then section 80TTA, this is interest on your savings account. You can claim deduction up to 10k. So after all these exemptions and deductions, net taxable income is 11,03,375. Tax payable including cess would be 1,49,253. Let's now compare this with the new regime. Gross salary would remain the same, 22,29,875. No exemptions. And when it comes to deductions, the only deduction available is standard deduction, 75k here. So net taxable income is 21,54,875. Total tax payable including cess, 2,48,268. As you can see, net annual savings if you choose old regime would be 99,015. That is nearly 8.3k extra per month in your pocket. And if you want to know more about all these deductions, again you can find the link of these videos in the description. Now the question, new or old, which regime should you choose? Of course, old regime, we have just seen from the case study, right? Well, the answer is not a straight yes or no because it depends. Of course, for our case study, CTC 25 lakh, old regime was better because you had key deductions and exemptions to claim. But new regime is still the best in 3 different situations. 1. If your salary is up to 12.75 lakh, because you get 100% rebate if you file your ITR. 2. Salary more than this limit up to say 25 lakh, because that's our case study. New regime is better if you have no or very few deductions or exemptions to claim. 3. If the salary is more than this limit, more than 25 lakh, again go for new regime unless you can match the higher income with higher exemptions or deductions in old regime. Just remember this, no deductions or exemptions, go for new regime. But if you have deductions or exemptions, then compare between the old and the new and choose what's the best. Now, how can you do this? You can use the tax calculator from the IT department website. You can find the link in the description. But if you're confused about using this calculator, again, I have a video on this topic as well. Link will be in the description. That's it for today. See you in the next video.